The other day, I was talking to a past client about refinancing, and the client said, "Hey, we are going to wait till September for the next Federal Reserve meeting when we believe that they will cut interest rates or cut the Federal Reserve Fed funds rate." So I wanted to talk today about that and help people understand that when the Federal Reserve cuts their Fed funds rate, that doesn't necessarily mean that mortgage rates are going to be cut. So we're going to take a closer look at that today. My name's Miles Pitcher. I own Superior Lending. So as of today, Jerome Powell made a comment. He said, "The time has come for policy to adjust," and then which means signals that the Federal Reserve has raised the Fed funds rate enough, held it long enough. It is time for it to start coming down. And as of right today, August 23rd, coming up in September, we believe that they will cut 25 basis points, maybe even 50 basis points in the federal funds rate. Okay, the Federal Reserve has a dual mandate. They work to get inflation down and to keep it at a healthy level, and then also work with the labor markets. Jerome Powell made comments that said, hey, inflation is coming down, it's moving towards their target, but now the concern is that the labor market is softening and potentially moving into recessionary situations here. So the question is, if you were doing a refinance or a purchase, is it better to lock in your rate now or wait for the Federal Reserve to cut their rates in September, a month from now? So let's look at this and understand it a little bit better. Mortgage rates are influenced by various factors. The Fed funds rate plays a role, but it is not the sole determinant. What I mean by that is that to mortgage rates, they're affected by market conditions, supply and demand, and investor confidence. And the market conditions, the supply and demand, really relate to economic data, what's happening in the jobs market, what's happening with inflation, what's happening with GDP growth, the economy as a whole. So there's a lot of factors that play into that. Mortgage rates often anticipate future economic conditions, okay? And then economic data can influence expectations about interest rates. For example, last week we had the unemployment report come out and show that the unemployment rate is moving up. This is beneficial to mortgage rates, okay? It significantly improved our rates, okay? The Federal Reserve is looking at the same data, and that's influencing their decision on lowering the federal funds rate, but our mortgage rates moved based on that economic data. So as data comes out, inflation data, jobs data, GDP, global data, our mortgage rates react to that. So here's a list of things that are good for mortgage rates. Okay, inflation, high unemployment rates. I should have said low inflation, weak GDP, low consumer confidence, declining home sales, low retail sales. Some of the other ones, global economic uncertainty, like sometimes war globally is good for mortgage rates. And then the low federal funds rates. So the anticipation of lower federal funds rates benefits our mortgage rates. Here's a chart of the 10-year Treasury. And this really helps you see the direction and movement of mortgage rates, okay? And you can see that everything is trending lower and better. Many of the big moves are related to inflation reports, lower or unemployment moving up and getting higher, bad economic data, and even comments from the Federal Reserve. So the bottom line here is the anticipation of the federal funds cuts coming up have already been priced into our mortgage rates. Comments or surprises out of the Federal Reserve could move the mortgage rates for better or for worse. But for right now, they have very high level of confidence that there will be cuts coming, and it's already priced into our mortgage rates. So the mortgage rates are smart. The bond traders are smart. They know what's coming up. They plan for it. They price for it. It's in the market. So to my client who is saying we're going to wait for the Fed Reserve to cut rates, well, it may or may not be beneficial to them. Hard to say, but I just want that client and others to know we've already priced it in. Here's how you can get a hold of me. My name's Miles Pitcher. We're always available to give a second opinion on anything. Thanks for watching this video.